If you were born before 1960, there are 5 recurring bills sitting in your mailbox or leaving your bank account right now that federal law, state law, or county policy has already decided you should not have to pay in full, and in some cases, not at all. We are talking about a real number. For the average homeowner over 65, the gap between what they are legally obligated to pay and what they are actually paying runs between $4,000 and $12,000 every single year. Nobody at the county is going to call you. The agencies collecting that money are not going to send a letter. Stay with me all the way to the end, because the 5th one on this list is the highest value of them all, and also the fastest to claim. Let me be precise about what I just said, because people hear something like this and immediately start deciding it does not apply to them. And that right there is the single most expensive reflex a retiree can have. Here is the gap. Being legally exempt from a bill and actually not paying that bill are 2 completely different things. The law does not send you a check. The county does not mail a refund on your birthday. The agency that has been collecting that payment from you for 30 or 40 years does not pause and say, "Oh, wait, this person qualifies now, let us stop." You have to know the exemption exists. You have to file the form. And that one step, that one piece of paper standing between you and money that is already yours, is the reason most people who fully qualify for what I am about to walk through never see a single dollar of it. Now, before I go any further, do me one quick favor. Drop your age and the state you live in right now in the comments below. I read every one of them. It tells me exactly who I am talking to and which rules to break down next. Age and state, write in the comments. Now I want to address the 3 groups of people who are watching this right now, because I already know what some of you are thinking. The first group is the comfortable retiree, paid off home, maybe a decent pension. You hear senior exemptions and you assume those are income-based programs for people who are really struggling and that you do not qualify because you are doing okay. I am going to show you in the next 20 minutes exactly why that assumption is costing you thousands of dollars a year. The second group is the retiree living mostly on Social Security. You hear about property tax savings and home exemptions, and you assume those programs are for the wealthy homeowner with the big estate and the fancy accountant. Both of you are wrong, and both of you are leaving money sitting there with your name on it. The third group is the renter. You are about to click away because you do not own a home and you think none of this applies to you. Stay right there. Because one of the 5 things on this list controls how fast your landlord is legally allowed to raise your rent. And a second one is a direct federal credit that pulls money off your phone or internet bill, whether you own or rent. This video is for you too. I have sat across from county assessors, IRS agents, and probate clerks for 15 years. Every video I put out gives you one specific form or one specific phone call you can make this week. No theory, no fluff. Nobody else is doing this for the 65+ audience in plain English. If that is useful to you, hit subscribe and the bell right now. I post new ones constantly, and I do not want you to miss the next one. On every single item on today's list, I am going to tell you exactly who it helps the most, so that no one watching can honestly say, "Well, that part is not for me." My name is Walter Barron. I am a state bar licensed estate attorney with over 15 years sitting across the table from county assessors, probate clerks, and IRS revenue agents, and I will tell you the single most painful pattern I have seen in all those years. It is not the person trying to game the system. Those people are rare and they eventually get caught. The painful one, the one that stays with me, is the honest person in their late 60s, 70s, or 80s. Someone who has done everything right their entire life. Paid the bills, filed the taxes, never asked for anything they did not earn. And that person is quietly sending out money every single month that they have been legally exempt from for years. Not because they cheated, not because they were careless, because not one person ever sat down with them and said, "Here is the specific form, here is the deadline, here is the phone number to call." That is the most expensive kind of mistake there is, because it is completely invisible. There is no late notice, there is no penalty, there is no alarm, there is just money leaving your account, month after month, year after year, that never had to leave at all. Today I am going to walk you through 5 of these, one at a time, in plain English, with the exact thing to ask for on each one. Then I am going to give you 2 or 3 bonus moves at the end for the homeowner sitting on real assets, because for the right person, those bonus moves are worth more than everything else on this list put together, And I want you to stay all the way to the end, because the fifth item is the one that costs people the most every single year, and it is also the easiest one to fix, starting this week. Let us start with the newest one, because it is so new that most tax preparers have not built it into their standard checklist yet, and that is precisely why it is being missed. Starting with the 2025 tax year, every American who is 65 or older qualifies for a brand new bonus deduction of $6,000. And I want to be precise here because this is where people get confused. This is not instead of your standard deduction, it is on top of it, an extra $6,000 knocked off your taxable income, just for being 65. If you are married and both spouses are 65 or older, that is $6,000 each, $12,000 as a couple, stacked right on top of everything you already get. This benefit runs through the 2028 tax year. And here is the part that surprises people. You receive it whether you take the standard deduction or whether you itemize. The filing method does not matter. Now, this deduction does begin to phase out at higher income levels. For a single filer, it starts to shrink once income climbs past $75,000. For a married couple filing jointly, the phase-out begins at $150,000. Above the top cutoffs, it disappears entirely. But think carefully about who that leaves. The vast middle, the retiree living on a Social Security check, a modest pension, maybe a small amount of investment income. For that person, this is real money pulled directly off the amount the government is permitted to tax. Who does this help the most? The moderate income filer who does their own return or hands it to a preparer who is moving through 100 returns in tax season. That person is the most likely to have this line either missed entirely or applied incorrectly, and the least likely to catch it before signing. The action step. When your return is prepared this year, before you sign anything, look at the form and confirm the additional senior deduction was actually applied. If you file with software, verify that your date of birth is entered correctly, because that is the trigger that activates it. If you file with a preparer, ask them directly, was the 2025 senior bonus deduction included? That is not a confrontational question. It is a one-sentence check on a deduction worth $6,000. And here's a deadline you need to know. For the 2025 tax year, the standard federal filing deadline is April 15th, 2026. If you have already filed and this line is missing, you can file an amended return using Form 1040X and claim what you are owed going back 3 years. One more thing before we move on. In a lot of states, your state income tax return has its own senior exemption on top of the federal one. Illinois offers a senior exemption. New York has an additional deduction for income from retirement accounts. Georgia excludes up to $65,000 of retirement income from state tax for residents over 65. So when you are checking the federal return, check the state return at the same time. Number 2 is your property tax bill, and this is where the largest dollars on this entire list are hiding, because there are actually 3 separate forms stacked on top of each other, and most homeowners over 65 do not have a single one of them filed correctly. The first is the Homestead exemption. What it does is take a chunk of your home's assessed value off the books before the county calculates what you owe. In Florida, that chunk is $50,000 removed from your assessed value. In Texas, the Homestead exemption removes $100,000 from the school district portion of your bill. In Georgia, homestead exemptions vary by county but commonly run between $2,000 and $10,000 off assessed value. Here is where people get burned. Most homeowners assume the homestead exemption is automatic, that it just happened when they closed on the house. In most states, it is not automatic. You have to file a one-page form with your county assessor's office, typically before a spring deadline. In many states, that deadline is April 1st or May 1st of the year you are applying. File it one time, and in most states it stays on file as long as you own the home. Miss the deadline and you pay the full bill that year for no reason at all. The second form is the senior or over 65 exemption. Most states that offer a homestead also offer this additional layer, and it activates the year you turn 65. The county will almost never mail you notice that it exists. It is a completely separate application, and you have to ask for it by name. In Texas, homeowners 65 and older receive an additional $10,000 off the school district portion of their bill, on top of the $100,000 homestead. In Florida, qualifying seniors can receive an additional $50,000 exemption on top of the basic $50,000. In Illinois, the Senior Citizens Homestead Exemption provides an additional $8,000 reduction in equalized assessed value, and it stacks with the standard homeowner's exemption. Now here's the point where comfortable homeowners wrongly tune out. They hear senior exemption, and they assume there is an income test they will fail because they are doing reasonably well. But in more than half the states that offer this exemption, there is no income test at all. In Texas, Florida, Georgia, Tennessee, and Alabama, turning 65 is the only qualification. Age is the test, nothing else. The third form is the most valuable of all, and the least discussed, the assessment freeze. When you file a senior assessment freeze with your county, the county locks in your home's taxable assessed value at whatever it is the year you apply. From that point forward, it does not matter how much your neighborhood appreciates. Your tax bill is calculated against that frozen number. In Texas, once you file the over 65 tax ceiling, your school district property tax is frozen at the actual dollar amount you paid that year. Your home can double in value. The bill cannot rise. In Illinois, the Senior Citizens Assessment Freeze Homestead Exemption works the same way. Once filed, your property's equalized assessed value is locked. Who does this help the most? The homestead helps the lower-income homeowner the most in raw dollar-per-dollar terms, but the freeze is worth a fortune to the person sitting on a paid-off home that tripled in value over the last 10 years. Renters, I told you, this one was yours too. Your landlord pays the property tax. Your landlord passes every dollar of property tax increase into your rent. When those bills freeze across a community, rents stop climbing the way they have been. The action step: call your county assessor's office. That number is on your property tax bill. Ask 3 specific questions. Is the homestead exemption on file for my property? Is the senior or age 65 exemption on file? Is the senior assessment freeze on file? If any one of those is not on file, ask what form adds it and what the deadline is. 3 questions, 1 call. That is all this takes. Number 3 is the bill that most people do not even see leaving their account, because it gets pulled out of your Social Security check automatically before the money arrives. In 2026, the standard Medicare Part B premium is approximately $185 a month, gone before you ever see it. But here is what almost no one is told. There is a set of federal state programs called Medicare Savings Programs. If your income falls under the qualifying threshold, your state will pay that Part B premium for you. Not reduce it. Pay it. Every dollar of it. There are 3 tiers. They go by the initials QMB, SLMB, and QI. The most generous tier, the QMB, or Qualified Medicare Beneficiary Program, does not just cover your premium. It also eliminates most of your Medicare deductibles and copays. For someone seeing doctors regularly, the total annual value of QMB can easily exceed $3,000. Here is what bothers me most about this one. The income limits are significantly higher than most people assume, and a growing number of states have eliminated the asset test entirely. Your savings account balance, your paid-off house, your car, none of those count against your eligibility in those states, and yet this remains one of the most underclaimed benefits in the entire federal system. Who does this help the most? Anyone living primarily on Social Security. $185 a month is over $2,200 a year, but even a household with moderate income near the threshold should make one call to find out. The action step: call your state SHIP office, the State Health Insurance Assistance Program. It is free. They will screen you for Medicare Savings Programs and walk you through the application. To find your local SHIP office number, search SHIP Counselor plus your state name, or call 1-800-MEDICARE and ask to be connected. While you have them on the phone, ask about Extra Help, also called the Low Income Subsidy. It targets your Part D prescription drug costs. In many cases, getting approved for a Medicare Savings Program automatically enrolls you in Extra Help. That is 2 of the largest health cost breaks in the system, both unlocked by one application. Quick gut check before we keep going. Drop 1 word in the comments right now. Homeowner if you own your home, renter if you rent, or widow if you are a surviving spouse. I am reading these and they tell me which forms to prioritize in upcoming videos. Number 4 is smaller in dollar terms, but I want you to hear the stacking argument before you decide to skip past it. There is a federal program called Lifeline, administered by the FCC. It takes $9.25 a month off your phone or internet bill. Many states stack their own additional discount on top of the federal credit. In California, the combined credit can reach over $12 a month. In some cases, it covers the cost of a basic phone plan entirely. Separately, if heating or cooling your home is a financial strain, there is a program called LIHEAP, the Low-Income Home Energy Assistance Program. It helps pay your utility bill directly. In colder states like Illinois and New York, annual LIHEAP grants can reach several $100s. But here's the stacking argument I want you to hear. $9 a month does not change your life by itself. So let me add these up. The Lifeline credit, the LIHEAP energy assistance, the Medicare Savings Program eliminating your Part B premium, the senior assessment freeze stopping your property tax from rising. Stack 4 of those together for a qualifying household, and you are looking at over $400 a month staying in your account, almost $5,000 a year, from bills that were already legally yours to reduce or stop paying. The action step for Lifeline. Visit lifelinesupport.org or call your phone provider directly and ask whether you are enrolled. For LIHEAP, call your state's Energy Assistance Office, search LIHEAP plus your state name, or call 1-800-352-2572 to be connected to your state office. Now we arrive at the 5th one, the one I told you at the very beginning to stay for. And I want to spend real time on this, because this is the one that quietly costs people the most year after year, and it is also the one that has a fix you can put in motion this week. You already know about the $6,000 bonus deduction from item 1, but on top of that, the tax code provides every filer who is 65 or older a second, completely separate additional standard deduction. This one has been sitting in the law for years. For a single filer over 65, it adds roughly $2,000 to the standard deduction. For a married couple where both spouses are 65, it adds approximately $3,000 total. Let me put all 3 layers together. A single filer over 65 in 2025 gets the regular standard deduction of $14,600, plus the long-standing senior add-on of approximately $2,000, plus the new $6,000 senior bonus deduction, for a combined deduction of over $22,000 before they owe a single dollar of federal income tax. A married couple where both are 65 or older gets the regular standard deduction of $29,200, plus the 2 senior add-ons of approximately $3,000 total, plus $12,000 from the new bonus deduction, a combined deduction pushing above $44,000. What does that mean in practice? It means a very large number of people over 65 owe far less in federal income tax than they believe, and a meaningful number of them owe nothing at all. But here is the trap. Those same people keep over-withholding from their pension check, their IRA distributions, or their Social Security benefit out of decades of habit. So they hand the federal government an interest-free loan every single year and call it normal. Who does this help the most? The retiree who had a working years preparer they trusted and never changed, and who never told that preparer, "I am 65 now, is there anything different about how we should be filing?" That is the most common version of this mistake I see. The action step. When your return is prepared this year, ask your preparer 4 specific questions. Was the regular standard deduction applied? Was the long-standing senior additional deduction applied? Was the new 2025 senior bonus deduction of $6,000 applied? And given my actual tax liability, should my pension withholding or IRA withholding be adjusted going forward? The right withholding adjustment means you stop lending the government money every month and start keeping it yourself. If you have already filed your 2025 return and you are unsure whether these lines were applied correctly, you can file Form 1040X, the amended return, and recover the difference going back up to 3 years. Now, if you own a home that has appreciated significantly, I want to give you 2 more moves that almost no one talks about. Bonus move 1, property tax deferral. In a growing number of states, including California, Texas, Washington, and Oregon, once you reach a qualifying age, you can choose to stop paying your property tax bill entirely during your lifetime, and the state places a lien on the property that gets settled when the home is eventually sold or transferred. You keep your cash flow. The state waits. Call your county assessor's office and ask whether a senior property tax deferral program is available. Bonus move 2, the surviving spouse carryover. When one spouse passes away, the senior exemptions and the assessment freeze do not automatically transfer to the surviving spouse in many states. Families lose them by accident, often in the worst financial year they will ever face. But if the surviving spouse files the correct paperwork within the specified window, they can often preserve those exemptions. In Texas, the surviving spouse of a deceased 65 or older homeowner can inherit and maintain the over 65 exemption if they were at least 55 at the time of the spouse's death, and they file the required application with the county appraisal district. Do not wait for the county to tell you this. Ask, let me bring this back to a real person. I once worked with a woman I will call Margaret. She was 72 years old, living outside Columbus, Ohio, a widow, paid off home that had quietly doubled in value over the years, getting by on Social Security and a small pension from her late husband's employer. And when we sat down and looked at her situation, here is what we found. She was paying the full Medicare Part B premium, pulled out of her Social Security check before she ever saw it. She qualified for the QMB program. She had never applied. She was paying the full unfrozen property tax on her home. In Ohio, the Homestead exemption for seniors reduces the taxable value used to calculate the property tax bill. She had never filed it. She was over-withholding from her pension by roughly $90 a month because her preparer had never applied her senior additional standard deduction or adjusted her withholding for her actual tax liability. 3 separate mistakes, each one invisible. None of them came with an alarm. So we filed 3 documents: a Medicare Savings Program application with her county SHIP office, the Ohio Senior Homestead Exemption form with her county auditor, and a corrected withholding instruction to her pension administrator. Nothing about Margaret's life changed. She did not move. She did not sell. She did not refinance. The only thing that changed was the number at the bottom of her bank statement at the end of the month. $340 more stayed in her account every single month. Over the first full year, that was just over $4,000 she had not seen in years. From the same income, the same house, the same life. She was not gaming the system. She was not getting away with anything. She was finally claiming what she had already earned over a lifetime of doing everything right. That is the entire point of what I have been telling you today. Here is what I want you to do this week. None of this costs $1. Call number 1. Call your county assessor's office. The number is on your property tax bill. Ask whether the homestead exemption, the senior exemption, and the assessment freeze are all on file for your property. If any one of them is missing, ask what form adds it and what the filing deadline is. Call number 2. Call your local SHIP office and ask to be screened for a Medicare Savings Program. While you have them on the phone, ask about extra help for your Part D drug costs. Step 3. The next time your tax return is prepared, confirm that all 3 layers of your senior standard deduction were applied, the standard, the senior add-on, and the 2025 bonus, and ask whether your withholding should be adjusted going forward. If the cost of a tax preparer has been part of why you have been putting this off, this last part matters. There are 2 free programs staffed by IRS certified volunteers that will file your return for you at no charge. One is called Tax Counseling for the Elderly, or TCE. The other is AARP Tax Aid. Both specifically train their volunteers on senior deductions. You can find a local site by calling 1-888-227-7669 for AARP Tax Aid, or by visiting the IRS Free File page and searching for TCE locations. The preparation is free. The result is a return filed correctly. If you do nothing else this week, do this one thing. Call your county assessor's office and ask those 3 questions about your property exemptions. That single call could be worth $1,000 a year or more. Type the word yes in the comments if you are going to make that call. I will be reading. And if you want the one-page version of everything I just walked through, with the state-by-state deadlines and the form names written out, I have put a checklist at walterbarronlaw.kit.com. Link is in the description below.